Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 30th, 2025. I'm host of InvestTalk, Justin Klein. I appreciate you all tuning in, liking, and subscribing to this channel, as well as our podcast, InvestTalk. Now, this week I'm titling the video, Markets Remain Indecisive, but a big week ahead looms large. And we'll dig into the economic data for this week and what we have coming up. But first, I want to start off where I always do, which is kind of a review of the market. You can see this. I love the heat map. It just kind of gives you a sense of what sectors are doing well, what companies are doing well or not over different time frames. This is year to date, so you can see a lot of green, a lot of red, very mixed. Which where are the markets for the year to date? S&P, it's roughly flat on the year. So not a shock to see this type of view here, where you have even the Mag 7, you have Tesla, Amazon, Apple, Nvidia now negative, and Google negative on the year. We have Microsoft, Meta, Netflix, Broadcom. Those are in the green. So mixed bag overall. And let's check out the weekly though. And you can see you had a relatively strong week. Only a few in the red, and mostly everything is green. So we can dig in the charts and see what this ultimately means. But first, let's get to the economic data. Now, we'll start off with this, which is the durable goods new orders. This excluding defense. I always like to get rid of defense there. That's a lot depending on what government's doing, right? Government spending is looking like. Year over year, it did decelerate a little bit, but still in an uptrend, right? We were in deeply negative territory last summer, and we've been improving since. So overall, that's in good shape. Richmond Fed manufacturing, it still has a negative 9, but better than April. But this is where I think the more consequential numbers are coming in. Initial jobless claims, it came in at 240, about I think 10, 12,000 more than expected, and in the high end of the recent range. And it's not breaking out of the range, so that's kind of you could say this is just kind of noise, and that's certainly true. But I always focus on this. This is continuous claims. It means people that how often are people getting off unemployment versus being actually put on. And when more people are being put on than coming off of it, then that means the labor market is getting materially worse. And this is a 3-year chart, and you can see we've been we'll go to a 1-year. We've been kind of in this range here between, call it 1.89 and low end 1.83. But what you can see here is the last 2 weeks. Previous week we're at 1.89. And then we broke out to 1.92 this last week. So this is above range. We'll get another number next week. And I think that will be important to watch, because this will be, I think, an early indicator of where the labor market is headed. So this is my first kind of red flag on the labor market that I'm holding up here. Doesn't mean it's a death knell, but it's certainly starting to develop a trend here now, right? Higher low, breakout. You look as if this was a stock chart, you would say this looks like a breakout. But obviously that could change, and you want a confirmation of that breakout, and we'll get more next week. Pending home sales index, that did fall again. It's still down a couple percent year over year. And the housing market has been in a rough spot for a couple of years now, but it does look to be getting marginally weaker, kind of similar to what's happening in the labor market. And that could be the reason, right? We've had 7% mortgages for a while, but if the labor market is cracking, then obviously that's going to feed into people buying homes, because they're either going to not have they're not going to be comfortable buying a new home if they feel that their job may be in jeopardy in some way, shape, or form. On the inflation front, that did decelerate. This was kind of in line. Core PCE, this is something the Fed watches, is down to 2.5. Certainly will give the Fed more ammunition or more credence to cut rates at some point this year, but this won't be in June. This is coming up here in about 2.5 weeks, June 18th, and there's a 98% chance they will be doing nothing. And I agree. There's really no reason. Market rallied. We're kind of flat on the year. The economic numbers are okay. Really no reason to cut. But you get out to July, there's a modest chance of a cut, 22%, but still really not that high. September is really where the first cut is being priced in here, right around 50. If you combine these two numbers, you're talking about a 75% chance of one cut by September. And then October, you have a little bit higher chance of another cut, but December, that's that second cut there, may be leaning on the third cut. So 2 to 3 cuts. I lean at closer to 2, but we shall see with the economic numbers. I always like to follow this bank credit. I always talk about how this is important to make sure banks are opening up their balance sheet and lending into the economy. And if they are, that is typically inflationary, or at least good for liquidity dynamics in the market and the economy. And so far, this has taken another stair step higher, really since late March, since call it Liberation Day. So how much of this are businesses needing to borrow versus and taking advantage of credit lines and taking out loans, and banks really having a lot of reserves that are able to lend out there. They're going to get probably uh, more loosening of regulation to allow them to lend more, and so maybe they feel more comfortable lending and not worrying about their balance sheets coming under stress. So that's something to watch for as well, to see if this trend stays intact. And like I said, this had a little pullback through mid-May, but you've got a little bounce here as we get into the end of May. So we'll be watching that. This is also the Treasury account weekly average. So what you can see here, this peaked out around 828 billion back in February and was drawn down in a big way all the way into April 9th, Liberation Day. And overall, that is a positive to liquidity when this is being drawn down. Now, they're going through Congress trying to get the bill passed and spending and all of that. And that's and to raise the debt ceiling, and that will ultimately allow them to refill the Treasury General account, which actually be net negative for at least near-term liquidity. So we'll see kind of where this goes. But right now, this is I think another reason why the market did bounce here is the Treasury General account being drawn down from about 600 billion to 467 billion. So nearly, how to call it, 130 billion dollars being drawn down into the economy as a whole. So that is kind of where we're at on the economic front. Oh, actually, let me get into that. Let me get into, where are we? There we go. I want to get into next week, because I talked about how next week is a big week. And this is coming up on Monday. We have construction spending and ISM manufacturing PMI. Those will both be important. And then we get into job openings, JOLTS, right? So this has been coming down. So another indicator on the overall economy. Does this take another stair step lower? Do we get a bounce? What are labor markets feeling about the current economic picture? And then you have durable goods as well that will be coming in. What else do we have? ISM PMI. Okay, services PMI. That's most important, right? Because the most of the economy is services. Services will be very important to watch what that looks like. And then we have productivity for the first quarter revised. That came in negative. That was bad. So we'll see if that can be revised better. We get more initial jobless claims. See if we get a continuous claims acceleration. We have the ADP number on Wednesday as well. ADP employment. Thursday we have what else do we have? Yeah, those are the main ones. And then Friday we have the big number, which is the non-farm payroll report. And are we getting acceleration once again in the labor market, or deceleration? And I will be watching that. So that's why I say it's a big week that could shake us out of this range. And when I say this range, let's go back here. So let me clean this up, because this is no longer really relevant, because we got above that 7.5 retrace there. We retested it really. We retested this little breakout area on, what was that, on Friday. And then last week we got Tuesday, we had the nice move, and we really consolidated that move. So kind of a micro bullish, but we didn't get above this high. So really, so far, we actually made a lower high. We got a fade on Thursday. We had NVIDIA earnings. Let me pop over there real quick. We had NVIDIA earnings, and overnight, they're pretty good. I think it was up 6, 8, 10%, something like that. And then we faded. Actually, I can tell you, because we can dig into a shorter term chart. Yeah, overnight, let me go to a 15-minute chart. There we go. So this is the earnings overnight. We popped all the way up to 144. opened around 142, but faded throughout the day, closed around 140, 139-ish, and then had followed through the downside on Friday. So this was definitely not a great look from a technical perspective, having that rally into these areas of previous pivot points, and we faded from there. And you're going to get a MACD rollover, and if you can go to a weekly chart, what you can see here is, this is a little topping tail here at resistance. So MACD is crossing the zero line to the downside. NVIDIA is a very important stock when it comes to the broader market. So if this is losing its momentum, it's topping out, that would be bearish for the overall markets. And so let's go back to the S&P. We'll do it on a weekly chart, but we'll look at a monthly as well. What you can see here is we had that 2 weeks ago. We had that nice fall through from the the pause, the pause on the Chinese tariffs are bringing them down to 30%, and then then the 90-day pause, and then we had a little pullback that held the low from the previous week, so that was good, and then you had another inside week this week. So really not a whole lot doing. You can see the MACD line is below the MACD line is below the zero line, so that's also something of note. When this gets below zero, that is a downtrend signal, and I'll be watching for that to see if that holds. On the monthly chart, because we get a month end here, we had that big wick in April, but May we did rally, but we didn't get above the March highs. So that's where I'm continuing to look for, and this is why, if I zoom out to back to the daily chart here, what you can see is we remain in this overhead resistance right around the 50. Now I'm going to call it 6,000 on the S&P, and we're testing there. We're in this indecisive phase, as I said at the title of this video, because we're not breaking above it, but we're also not breaking down below this 5,800 level on this P, and also this is gap fill. So we have this gap here, and that tends to be support as well. Just do this. So that's going to be support, right around that 5,700 level. So that's probably even more important, to be honest with you. Breaking this level 5,700, that would create a downtrend, lower high, lower low type of situation, and would hurt the technical picture overall. But I don't really think you get really bearish until you get below this 5,700 and this gap fill and kind of close there on a weekly basis. That's where I would say, okay, this is just a counter trend rally. We're making a big series of lower highs and lower lows, and that's a broader downtrend. So we'll be watching that, and obviously there's a lot to be said about the economic news that's coming out this week and what where the market really heads. I think there's a lot of indecision about where the economy is at after these the damage being done to the psyche of the consumer, of the business, et cetera, and a lot of indecisiveness. I'm in a group of other business owners that have all different types of businesses, many of them manufacturing, some of them in tech, related to manufacturing, and they're all I would say they're concerned. There's a lot of indecisiveness and a lot of just worry about the future of the economy. So if that's those are small businesses, it could be a microcosm of the broader economy. It's a small set. It's only about 6 other business owners besides myself, but it still gives me a good picture into what is happening out there in the business community. Now let's dig into some of the other sectors as well. Let's go based on kind of what did well on Friday. We had utilities close the week strong, and what closes the week strong and doesn't. I think it is important because a lot of times you have big institutions that are closing up their books for the week, and they're either getting positions on or taking positions off, and utilities rallying into the close was of note, especially when you look at actually bonds. Bonds actually rallied here, so that was interesting. So bonds are continuing to move to the upside, and money is moving into safety to a degree. And then you have the gold market, right, closing strong. Here's the junior miners. Here are the senior miners. And if I go this, I always love this ratio. So this is GDXJ to the GDX, and money's moving into the junior miners. So that means that they are investors are more confident, taking more risk within that space, and that tends to be good for the precious metals. Same with here is the silver miners. What else? Well, here's the IEF, like I said. Also, Europe to the S&P. So this uptrend remains intact. Even though we've had the rebound in U.S. stocks, overall, this is still making higher highs, higher lows after a long, long period. I'll zoom out to a weekly of this underperforming, right? This being in a downtrend. I'll even go to a monthly chart here. And all this period was S&P, U.S. stocks outperforming the foreign stocks. And now you're starting to get this durable trend. Now, do we get a reversal? Kind of like will this be a false move like it was in 2023? Or not. I think if you get above, especially this 50-month moving average, that will be a strong indicator that the move in foreign stocks compared to the U.S. market is on. And you look at the MACD here; it's below the zero line still, but it's threatening, right? It's making it's a MACD what we call divergence, right? This made a new low here earlier this or late last year. But the MACD didn't. The MACD made a higher low. So there's definitely strong indication that foreign markets are set to outperform the U.S. market. Here are the financials. So financials, go to a daily here. Financials did close relatively strong. And if I zoom back over to that heat map over here, which you can see if I go to a year-to-date chart, a lot of I think the financials have the concentration of the most green. The only thing that's been really red are anything related to private equities. So you have KKR, BlackRock, Blackstone, what else here? Apollo. You can see anything that's related to private equity. Here's Coinbase. That's obviously related to crypto. Yeah, there's Apollo. What else do we got here? Simon Property. That's more of a REIT. So a lot of the banks, they're doing okay. They're hanging in there. Schwab up 18% on the year. So things are, I think, looking up for the financial space as a whole, which tells me it's hard to get super bearish on the economy as a whole, or at least the markets as a whole. I think a lot of what could happen in the markets is that rotation to foreign stocks out of U.S. stocks, but not really anything going to hell in a handbasket or anything like that. Just kind of a incipient rotation that happens within markets, and the fact that financials are hanging in there kind of tells me that. Let's look at. I'm just kind of going down my broad market watch list and see what kind of closed strong and what didn't. So as we go deeper, you'll see things that don't close the week as strong as others. The yen was strong. That tends to be good for the gold market because weaker dollar. And then you also typically, if this continues to get strong, it could be a catalyst of another yen carry trade unwind like it did last summer. See this move over here on the left. Do we get another big breakout and an unwind and a selling of U.S. equities, et cetera? Here's the NYSE. Let's actually look at this because remember, this is 2,500 names. This is much broader than the S&P or the NASDAQ or anything like that. And I still see this line in the sand here where you had this pretty rough month of March, and we did not get above it, and this MACD is rolling over. But over on a monthly chart, it's still looking okay. Weekly chart, that's also threatening the zero line as well. So this is looking similar, but obviously a bit weaker because the small caps are weaker. Healthcare, this was interesting to me. I'm starting to look how weak healthcare's been. I actually think healthcare is starting to look attractive. Just the money flows starting to get, MACD divergence here. I'm starting to think, with what was it, UNH? Yeah, here's UNH. And the pharma industry, things are looking. I think the sentiment is just there to buy some of the healthcare names. Now, a lot of them will continue to struggle, but I do think if you're adding a particular name within the healthcare or within the market, I think being selective within healthcare is important, but I would be looking through that market to see where the opportunities are. Now, I don't really think they're in UNH, but it could be wrong. But I think other types of healthcare businesses will continue to do well over the medium term. And so I would be looking to add some healthcare names. Let's look at TLT, 30-year. That did bounce a little bit on the week. Not as strong as the IEF. So clearly the yield curve is steepening, and it's a bearish steepener. So that's not necessarily a great thing, but at least the cost of capital is coming in a bit. Junk bonds, those remain strong. Here is the JAAA. So this is of note. Look how strong this is. Isn't that getting a nice rebound? This is the collateralized loan ETF, short term. So the fact that this is now above the 200-day moving average is important to me. But this is all in relation to private equity, private credit, private debt. And I do want to continue to highlight this because this is where the potential problems in the market are. Is if this is, I don't know why Apollo is not pulling up here. If this area continues to struggle, let's try Blackstone. There we go. Now this is making a higher low here. Could this be making a move potentially? But this is where the risks are in the credit markets, in our financial markets. BlackRock, that's a bit better. Let's look at KKR. BlackRock's more diversified than a lot of the Apollos or KKRs. This is looking okay, but I'm continuing to watch that to see if that continues with its rebound. Real estate did fairly well this week. That was okay. Materials hung in there as well. That's just consolidating bullishly above the 100-day moving average. And let's look at the dollar index. That's weak, right? So anything that is connected to the dollar, anything commodity related, that is getting a bit of a tailwind. Same with USO. You did have some news, I think, after the close around more supply coming out of OPEC, and could that push oil down? If this doesn't really push oil down to 50, I think it's pretty bullish for oil overall. And I think a lot has to do with shale. Shale's just not very profitable. They're not going to put new wells in below 60. It just doesn't make sense. The profitability metrics just really aren't there. So I do think that there could be some opportunities in the oil space in the shorter term, especially if this news doesn't really put you in new lows. Let's look at the MOVE index. Take a look at that. That's down, so that's overall positive for markets. This is not trending higher and threatening dysfunction within the credit market, the treasury market. So that's overall a good thing. Let's look at the VIX as well. So the volatility index, I talked about this. This needs to break, I think, the lows from March for me to feel confident that we're in a durable uptrend. Durable uptrends, if you go back, they tend to settle down in volatility kind of in the mid to low teens, right? 15, 14, 13. You get down in there, hey, market's not worried about much, and volatility is now trending lower. So far, despite this pullback, you're not making a new low in volatility since March. And that higher low could be telling us something about the coming couple of weeks. So that's kind of where we're at. It's certainly a market that is indecisive, but I think we do break out of this range over the next week or two, between now and call it June OPEX. And June OPEX is 3 weeks away. Okay, so we have June 20th, just after the Fed announcement. That will be an important announcement as well. What do they feel like when it comes to policy going forward and the broader economy? We have July 9th is the 90-day pause from the post-Liberation Day pause on tariffs. There was that news around courts are saying these tariffs are not legal, but that's going to an appeals court, and we'll see really what happens with that. But I don't really hold a lot of credence that the courts are going to do a whole lot. They'll find other reasons and other statutes that will allow them to implement these tariffs, I think, at the end of the day. So that's kind of where we're at. And I want to remind you the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.